It's Thursday, January 20th, 2022. And today we're talking about the future of work is getting funded, the secrets behind 1Password's raise, space tech is blasting off in Canada, temporary tattoo maker Inkbox, permanently acquired by Bic, Canalyst raises $70 million US, and Shopify enters China. Let's get started. First, the future of work is getting funded. Alex, am I looking at the future of work right now? You working from home, holding a microphone in your hand?
Yeah, with my kids in the background. Hopefully we don't get disturbed today.
Okay, so what's the future of work really?
Well, the future of work is how do we actually, everyone talks of the future of work as Zoom and Slack. That was the future of work pre-COVID. Now, COVID's actually changed how we've actually working. We're seeing new sets of companies emerge to reflect the reality of hybrid, distributed but non-distributed work, different, lockdowns, non-lockdowns, and changes of and addressing new problems that have emerged over the last 2 years.
But are these problems temporary? Like, are they going to go back to the old future of work after the Omicron wave, for example?
I don't think so. I think what you're going to see is an emerging. We don't know what the future of work is, but we know there's new problems. So how do you deal with a team that's distributed but also has hubs and spokes? How do you deal with a team that half the workforce never met the other workforce before, which we'll get into with together later today? I think what we know for sure is that the 90% of people working out of offices and commuting 5 days a week is not going to be the way for most of the population, at least in the tech ecosystem.
All right, so give me an example of a future of work startup that's getting funded.
Venue.
That's a good one. I'd like that. But here to talk about the future of work and his new raise is Nathan Goldstein, the co-founder of Together Software. Welcome, Nathan.
Thanks so much for having me, Jason and Alex.
Thank you for joining us. So maybe, Nathan, you're the co-founder of Together. Why don't you tell us what the news is this week and why we have you on?
Sure, absolutely. So Together Software is a Canadian company that just raised $5 million to fix learning at work. And we're super excited to come today to talk about it.
So what does learning at work mean? What are you fixing?
Absolutely. So our mission is to ensure that every employee can find and learn from peers, mentors, and experts at their company. Right now, you're really only meeting 3 to 10 people that you work with day to day, and you're not meeting the other maybe hundreds or thousands of people at your company to learn from, get advice, and develop your career. And so we enable employees to connect with others they would have otherwise never met for learning, networking, and advice. I can give you a couple of quick examples.
Sure.
For example, at Airbnb, maybe you're a first-time manager looking to connect with other first-time managers struggling with the same problems. Maybe you are at Discovery Channel and you're part of the Discovery banner, but you're really interested in learning more about Animal Planet or HGTV and finding a mentor from there. So we'll help you connect and learn from other people in sessions synchronously.
Cool. And I think you launched in 2019. Tell us how you got started and how you got Together off the ground.
Yeah, absolutely. So my co-founder and I met at the Boston Consulting Group. We were working in Toronto on Bay Street, and we really had a great career development and learning experience at the Boston Consulting Group. And we started to think about how do we bring this to all the other companies out there in the world in a scalable way through software. I had an engineering background from McGill University, so I decided maybe we can build a product out of this. And very quickly, after speaking with vice presidents of human resources and a lot of chief human resources officers, we found that mentorship and the speed of knowledge transfer was the most important thing on their mind. So we got started building.
And talk about us how COVID changed your clients' needs and what you guys did.
Yeah, absolutely. So really, we think that learning at work right now and career development are just absolutely in crisis. The Globe and Mail, the New York Times recently posted an article called "Remote Work is Failing Young Employees." I don't think that this is just a problem for young employees. I think this is a bias, maybe a bit of a bias, but it's affecting people at absolutely every stage in their career. Humans learn two ways. They learn independently, like through courses, education, or reading documentation, but they also learn socially through peers, mentors, and experts. And that is the part of learning that's absolutely in crisis right now, and people's careers are not moving forward. So our job is to fix learning at work.
And then tell us, you just raised this round. Tell us about the process. What were the setbacks and what advice and takeaways do you have for other founders?
Yeah, absolutely. So the raise, I mean, no raise is easy, definitely not. But for us, we basically were just on a mission to really communicate exactly how we're going to fix this problem and how we're going to scale to be a household name to absolutely every company. And so, basically, over the course of a few months, we were able to really attract some great investors. The fundraise is led by Altair, Track, Garage, Rebel, Funders Club, and many other investors that have supported great companies like Slack, Miro, and Instacart.
So talking about Slack and Miro, they seem to like Slack and Zoom and deals seem to be sort of I call like future work 1.0.
Mhm.
And you're, I'd say, future work 2.0, for lack of better. We could go Web 3, but we won't go there. What other trends, and Jason asked me how I saw work changing. How do you guys believe work is changing? What other trends and companies should we be looking at?
Absolutely. So a lot of those tools like Slack and Miro, and prior ones are really focused on the asynchronous part of work, which is things that are happening over instant messenger, documentation, boards, etc. What we're focused on is that synchronous piece of it. How do we learn from each other in person? How do we run better and more productive learning sessions and meetings? And so I think that's that added element that everyone's quite struggling with right now.
And then I imagine you're growing quick and hiring. Can you tell us about the sort of roles you're looking to fill?
Absolutely. So we are filling a ton of roles right now and looking for great, talented people to join our team to help fix this problem. On the technical side, we're definitely looking for product managers, product designers, and software engineers. And then on the rest of the business, we're looking for marketing managers, customer success folks, salespeople, and yeah, pretty much all the roles across the business.
How can people find out about you or connect with you about these roles?
Yeah, you can find us on togetherplatform.com. We've got a number of open roles. Please feel free to apply, and we've got a really great, talented team that since after raising this money, we've actually not brought in a lot of new management at all. We've promoted absolutely everyone in the company, and so it's just a testament to how strong the team is. And we love to continue hiring really talented people.
So, Nathan, thank you so much for your time. I really appreciate it. I guess one of the parts of future of work is everyone gets promoted. Uh, but thanks. Exciting to see you get raised. I hope you have keep on growing the business and make another huge Toronto behemoth.
Thank you, Alex. Thanks for having me.
All right, Alex, is it time for my promotion?
You can't get promoted anymore unless you were going to make. Maybe do you want to be Prime Minister of Canada? We
You
could
get
use new
promoted
leadership.
so high, you start from the bottom again, Alex. That's where I am. It's a circle. I'm right back at the bottom.
Circle
Okay,
of life.
so having spoken about the future of work with Nathan and learn more about Together, what do you think founders watching this stream can take away for their own businesses?
Um, I think first of all, just to any aspiring founder, the reason that we always need new startups is the world is constantly changing and creating new and unexpected problems that need to be solved. So if you were to go back to, let's say, 2020 and say, "Hey, I'm going to create a future of work company," people would say, like the future of work is already being tackled. There's this company called Slack. There's Zoom, and they're exciting but not growing that quickly. Um, and if you create something that's good, they'll probably go into that. But in reality, if you understand a new problem that's emerging before everyone else, you can go for an overlooked opportunity. What seems like a small TAM, but there's, if you can understand the trends at your back that are going to grow this, you can create the next large company. So it's not unusual that what looks like a small company, a small problem in a big market is ignored by the incumbents, is ignored by the VCs, and there's opportunities. Um, we talked about what does the future look like, future work look like. I still think it's in flux, And there are many problems that we haven't even addressed in this. Where are new employees located? Do they want to be in big cities? How does a DAO and Web3 impact how people want to work and their incentives? And climate concerns. Like, if you really believe people are focused on climate now, how does that impact how we work? These will all affect how we work. They will all present new problems that need to be solved and new startup opportunities. And then one thing about how Together, specifically related to a takeaway from Together, they took the risk out of the company. They proved before they raised this, they proved that large North American companies are willing to pay for their software. And then based on that, they said, look, we this is a less risky business. We proved, validated some of this customer. Give us money to go take more risk out of the business. Because if you read the press releases, we didn't get this in with Nathan, they're going to be expanding to smaller companies and international markets. And if they accomplish that, they'll be able to rinse and repeat. Now we've proven that large companies, medium-sized companies, international companies want us. We're a lot less risky. We're more valuable. Give us more money to keep on growing. So problems, my takeaway from these things, small problems with the right trends in the back are worth pursuing. We still don't know what the future of work looks like. And to raise money, your job is not just doing 100 things 1% better. It's taking risk out of your business.
I love it. And if you want to keep up to date on the future of work and more insights in the Canadian tech ecosystem, you got to subscribe to the TechTO newsletter. Head over to techto.org and subscribe today. Alex, what can people get in their inbox tomorrow?
Tomorrow's Friday, and they should have either a new VC or angel profile. There's a podcast recommendation that talks about TAM and how to explain what looks like a small TAM, maybe bigger if there's the right waves behind you.
Interesting. It's all about perspective
And knowing how to position stuff.
Positioning. I love it. Okay, you can subscribe to keep up to date with all the latest news, trends, and advice and events on our website at techto.org. You can also subscribe on our social media. Just look for the link in the bio. Next up, the secrets behind 1Password's raise. Now, before we get to the secrets, Alex, tell me about this raise.
It's a notable raise. They 1Password's actual incorporated company's AgileBits. They announced yesterday they raised $620 million US, led by Iconic Capital, Tiger Global, Lightspeed Venture Partners, and Excel. It's a $6.8 billion USD valuation. Half the raise is being used for secondary, half is a primary being used by the company. And there's a long list of interesting investors, including what I'll call the Avengers, because they have Robert Downey Jr., Chris Evans, and Scarlett Johansson, all played roles in Avengers. I don't know how they got together. Maybe they assembled. Oh, that's bad. Matthew McConaughey, Ryan Reynolds, Justin Timberlake, Pharrell Williams, and then like ex-CEOs or CEOs like Mary Barra from GM, Robert Iger from Disney, and the list keeps going on.
I guess when you raise around that big, you can fit a lot of people into it. So tell me what's so significant about this raise.
Well, first, it's the largest venture raise of all time in Canada. It surpasses your old employer, Wealthsimple, who raised 750 million Canadian in 2021, which was the largest raise of all time. Sorry, Jason.
I'm going to let you finish, but the Wealthsimple raise was the biggest. No, I'm just kidding. Keep going.
1Password is now more valuable than all but 5 listed companies and tech companies on the TSX. So you have a lot of Canadian companies on the TSX, tech companies. They're like, this is 1Password would be the 6th most valuable one if it was listed tomorrow at this price. 1Password really doesn't need the money. It's profitable. It doesn't need the funds. So and it's interesting, the way they're thinking about using this money is to go into more risky businesses by either building new products, hiring more people, and doing acquisitions. So we're saying, hey, our core business cash flow positive. This is our risk capital. And the one that I find interesting is this is 3.5 times more valuable than the raise we talked about 6 months ago.
Okay, so we did speak about a raise 6 months ago, and that was a big raise, right? That was $100 million. Was that right?
I think so.
In July 2021. Now, there were some secrets that we missed. I want to know what we got wrong.
So I think, so we can talk about what's happened since, but, our interpretation of that last round was off. We question what was implied. The valuation at that point was, was a $2 billion raise. I think revenue was out there at 120 million. And when we looked at the numbers, I said, hey, that's not even 20 times trailing revenues. Well, lots of publicly traded SaaS companies trade at 30 to 40. times revenue. What is this implying? Is this company slowing down? Are they seeing falling margins? Well, we were wrong. The company has grown revenue at an annualized rate of 60%, which, it's not a double, but it's really fast for a company coming off a 120 million base. It seems to be accelerating revenue growth because enterprise customers are about now 50% of business, and that's growing at 70% annually. So that's growing even faster than 60%. So, and the revenue multiple of this round is 2.7 times higher than the revenue multiple of the last round. So our interpretation from the outside was like, this is a company that's big, but seems to be slowing. Now it's trading, now it got raised at 47 times revenue opposed to 17 times. So my question was, did the last investors get a really good deal, or were these investors so desperate to get skin in the game that they paid any price?
And so what do you think the secret answer is to that?
A bit between A and B. When you don't need money, you can set the terms. And
Right.
part of this was rewarding employees. Like, look, you
said half was secondary.
It's half a secondary, and you have about 570 employees. That's 600,000 on average for employees. And I'm sure lots of those employees are new and don't have even invested stock. So my guess is the average money taken off the table by employees that took off the table is probably $2 to $3 million, with a skew, with a high tail at the other end, with a few people taking much bigger amounts.
Right. Okay. Very interesting. So you also mentioned that with this valuation, they would be like in the top 5 largest tech company in Canada, looking at the publicly traded comparables. How big is 1Password now?
It's at 150 million run rate. It has 100,000 corporate customers, 570 staff going to 1,000. So it's nice revenue, not a huge amount of employees, and it's growing relatively quickly.
All right. So what are the takeaways here for the TechTO community?
Well, first I'll start with if you're looking for angel investors, I'd be looking up senior 1Password employees, because
2 to 3 million per person in secondary.
and I think there was a secondary previously, so hopefully they've paid down their house and have money to invest in tech where they made it. I think this is a great example of capital allocation. Here's a company that says we have a core business spinning off cash, and we can fund the cash flow from our study business to do more experimental stuff, or we can raise risk capital and apply to risky opportunities. If they pay off, we'll get a more ROI that's in line with what our expected return is for that capital. So it's very interesting to see how they're doing it. Also goes back to, if you're cash flow positive, you can set your terms. And finally, I got to talk, I don't know, celebrity investors. I'm seeing this everywhere from A rounds and later. I don't know what the fascination with that. I got Fight Camp got Mike Tyson there and St. John Pierre. I understand St. George Pierre. It doesn't make sense. But when you look at our customers, there's a bunch of women between 25 and 45. I don't know if they really resonate with Mike Tyson here. Are they gonna have a 1Password product shot in the next Avengers movie? I don't know. What's other than
I think it's marketing to employees. I think it's about attracting talent and finding people that resonate with them, and having another proof point to tell your family and friends about how cool the company is. Because the truth is, enterprise security software isn't all that sexy.
So you're saying this is Ed Nevermont.
This is Ed Nevermont, classic marketing to employees 101. Look, I think also another takeaway is winter is coming. I mean, 1Password's core product that you talk about risk capital is because the core product is under attack. Who do they compete against? The biggest companies in the world, and they have platforms, and these guys are a feature in some cases. So they've got a lot. They've got some challenges going down the pipe, which is why it could be also an exciting time to join as well.
Yeah, and I'll say a couple more things. Just talking about winter, the public markets are getting beat up by investors, but it seems like private capital is still willing to pay for growth, and this could be a good way to get money while the going's good. And I'll say one last thing is a reminder that our analysis is based on non-insider information, and without all the facts, sometimes we could be wrong.
Good, important point to put in after I called this the secrets behind the raise. We are actually often wrong, if not more often wrong than right. Now, if you want to prepare for your own exit, you've got to join us next Tuesday, January 25th at noon Eastern, 9 a.m. Pacific, as we talk about your journey to exiting. We're going to be joined by the team from BLG, Canada's law firm, to talk about the strategy for big valuations. common mistakes, and what you can do now to start planning your big exit right. Tickets are free and available at TechTO.org. Alex, as an exit entrepreneur, what do you wish you did better to prepare for your exit?
Made my company more valuable.
Made the company more valuable. That's right. And operated in a more profitable industry with higher exit valuations.
Yeah,
with
get to
higher
one password
profit
size. We'll talk about valuations later today in this podcast.
Next up, space tech is blasting off in Canada. What is so exciting about space tech?
Well, let's first talk about the news that while we're talking about this.
No, let's start with why space tech is exciting.
Well, space tech's exciting because it's about space. People in technology talk about the future and what we could do, and you can't get more sci-fi than space. But you've really seen a decade of change in approach to space and the commercialization of space, and you see that with the funding. 3 years ago, funding was 30. The whole market was about 25 billion. Last year, 46 billion went to space. More importantly, 2.2 billion went to early stage space tech companies last year. So you've had the infrastructure like SpaceX gets satellites out, small cube satellites. Like this had to be NASA or the cosmonauts or China 12, 15 years ago. But with infrastructure from the early 2010s, there's a whole industry out there and it's emerging and it's now software.
It's becoming privatized. People are able to do hardware and software now without the backing of a big government.
I feel space is at where, AWS and cloud computing changed the ability for companies to come in and you could start a software company much more affordably. You didn't have to set up your servers.
Yeah.
Space now has an infrastructure. You can go get a small satellite. You can put it on the back of someone else's rocket and launch it in space. Now, still not $50,000, but it's no longer $200, $300 million to get into.
You make
business.
It sound as easy as opening up your Uber space app and doing a ride share up to space. But
I'm launching that next week.
That 2.2 billion that went into early stage space startups. Now that's globally. So let's talk about why you think Canada is really well positioned to benefit from this space trend.
Well, I think Canada has something interesting. We have actually 4 things that are interesting. First of all, we have great universities and engineers, and those are correlated. We graduate lots of people, but we have a lot of research universities across this country. They get a lot of funding, they do lots of fundamental research, and a lot of them focus on space, right? So this gives you the bare minimum you need to build strong companies in the space, right? And find that research that could be commercialized. Not all universities are good with tech transfers, but they're getting better. So that's positive trend. Second, we have some large space-related companies. They're not household names, but you got Telsa Canada, Earthycast. I don't know if I pronounced it right, but they provide know-how, experience, connections, partnerships, and the abilities to basically accelerate the startups. The third thing you have here, and I'm not usually a huge fan of this, but government financing. I think this is a perfect industry for it. It's again, we said it's not 50,000, but it's not 200 million. Now, when you got government that's willing to put one of the Wyvern raised money, the first few $100,000 came from government financing. This helps you take care of that research and prove that's commercial. Even venture capital doesn't want to take that. They want to take it when you got something that could be commercial, but that gap, the Canadian government's willing to finance that and help a lot of small business, give a lot of small business opportunity to take off. And we're a relatively politically neutral country. Maybe we're not on the best terms with China right now, but we're in better terms with China than the States. Europeans rather work with Canadian companies than Americans or Chinese or Russian. So it's actually beneficial to have a Canadian, flag on the company.
Got it. And the Canadian flag has flown with lots of different countries in space. So I think that is really cool. So now I'd want to know, with this macro trend, what's making space news in Canada this week?
Well, now we can get to Wyvern. They're based out of Edmonton. They announced $4.5 million in USD in financing over a few rounds and government funding. You got some U.S. investors leading the current round. Mac Venture Capital and Soma Capital and Liquid 2 are all participating. But interesting, early stage capital came from the federal government. The $235,000. They're not, what they're doing is they're doing actual hyper cameras to put on satellites to make hyperspectral imaging more available. There's quite a few actually Canadian companies doing hyperspectral imaging, and all of them have government funding or government as clients. Like I know another one in Vancouver where the Navy's, being the initial customer.
But what's nice about this, of course, I'm sure you like this, is that you see some private funding coming in after the government, validating it and not seeing it being a government-funded entity from start till finish, and then who knows what happens in there, right?
And then this is where the competitive advantage of government funding is here. Like the first money came in to get the prototype camera out, to show it can work. And this and again, why I said it's much cheaper to be a space company. This company still has not launched their first satellite. They're still not producing revenue. Without the 235,000, you couldn't prove that there's a potentially commercial tech. And now that 235,000 unlocked 4 million, which allows them to get into space and now see if there's a real business. So
I love it.
Yeah.
Okay, so you talked about a little bit what they do. Seems like it's a competitive market, a competitive space market. Why are they able to raise now?
Well, again, they've proven the technology can work, now, and they have a target market. Hyperspectral imaging, for people that don't know, it goes beyond what we can see as humans. It can basically see heat patterns. It could see different, basically different. God, my science is failing me, but different light, from heat and stuff like that. So they've got a bunch of potential agriculture customers that could say, "Wow, this is cool. We can look down. It's going to be affordable. It could be relatively real time, and this could change the way we do our business." So they could raise because they've proven that the basic technology works. They're about to put a satellite in space and get their first customers. And and I think what catalyzed and finalized the current round is they did get into YC, so that could help out too.
What an achievement!
YC accepts anyone these days.
That's right. They accept anyone. And okay, so if you are tuning in and you're thinking about your startup, is the advice to take away here, get government funding to start out?
No. I think, if you're in a sector that's very, I think the takeaway is there's a lot of very good research being done in our universities. And you could look at the tech transfer offices and government funding to help take that. Don't look for technology, look for a problem. But if there was a technology at a university in Canada where it could solve a problem you're trying to tackle, go talk to the university, talk to their tech transfer office, and talk to the federal government to get to the point where you can commercialize it. So that's a takeaway as a founder. I think as a potential employee, if you want to join a rocket ship company, there's a lot of great early stage Canadian startups across the country that you should look at that are on the cusp of going to the moon.
Very literally. I love it. Do we have a space list? We should have a Canada Tech space list, shouldn't we?
You can add it to the list we'll produce. Like I
add it to the list of lists. Add it to the TechTO meta list.
Yeah, it's a list of companies across the country. Like you got Wyvern here in Edmonton. You got Metaspectral in Vancouver, Kepler and Skywatch in Waterloo, and that's without me really doing any research or thought. I'm sure stuff in Montreal as well.
Awesome. Very cool. All right, so now we're going to do a quick lightning round. 3 more headlines to cover in 3 minutes. The first is some acquisition news. Inkbox is permanently acquired by BIC.
Yeah, BIC, the guys that make pens and a bunch of other stuff, acquired Inkbox for $65 million up front, plus an earnout. Inkbox had $27 million of revenue in 2021.
Wow. Okay, so what do you think of that multiple?
Well, it reflects how hard it's to build a DTC company and how lowly valued they are. Like, look, Inkbox is a huge success. Like, DTC is hard, direct to consumer is hard. You usually have lower gross margin, non-recurring revenues, consumer trends come and go. It's expensive to acquire customers. And you look at Inkbox, they actually broke all those rules. Temporary tattoos, high margins, a unique products. You don't have to worry about competition. I think tattoos is a non-trendy, non-cyclical product. Like,
you also have to educate the market if it's not a category that everyone's buying every day, right? And that can be time consuming and expensive as well.
Yeah, but despite this, the exit wasn't great. They got 2.4 times trailing revenue, while 1Password just raised it 45 times.
We can't compare it to 1Password.
But again, this is a company that did everything right in their category. They got to 27 million in 6 years, which is not, through the moon, but it's better than 99% of companies will ever see in their life. And the premium they got was 2.4 times revenue. So it's a good exit. It's not one that's going to change the ecosystem. You had great founders. Like, we've had Tyler up there explain how to do customer acquisition. These aren't guys that learned how to do customer acquisition. They knew how to do it. It was a science. So great company, but it shows you the headwinds of building something in the space.
So, any advice for the D2C founders out there? What can they learn from this news?
Don't overcapitalize your business. I think the biggest risk is, and we've talked about this before, like last week we talked about a Canadian size exit.
Mm-hmm.
I think a lot of DTC companies raise massive valuations like they are a SaaS business.
Yeah.
Don't raise that. Don't because I don't know. Again, I can't remember what Inkbox has raised in the past. This could be the amount the founders and the team take away depend on how much they've raised.
Sure.
If I imagine if you've raised 5 million, you're gonna be rich. You're not small, small exit of 65 million. You can buy your house in Rosedale, your cottage in Muskoka, and have money left over. If they've raised 55 million, they probably would have been better off working for 6 years at 1Password.
Well, that's almost certain, but I get the idea. So I think some hard takeaways there, but I think a big congratulations to the team, an amazing journey. And you know what? I don't think it's ending here. I'm excited to see what they do with the extra resources they get in backing from Vic, because like you said, these guys know how to do acquisition. They're playing in a really unique space. I think the story is just beginning, and excited to keep following it. Next, we got some fundraising news. Canalyst raises a $7 million US round. Who's participating in this round?
So this is $70 million. They're Vancouver-based, led by Dragoneer Investments, with participation from CPPIB and AltaFox, who are customers, High Stage Ventures, Van Edge Capital, and Scale Up Ventures. So you got funds from Vancouver and Toronto. The company has between 15 and 20 million USD revenue and 400 clients.
So what's the take here?
So just let's now compare this to DTC. Very different approach. A lot less customers. So you've got, if you look at it, they're raising at 18 to 20x revenue. If you assume a 350 million valuation, you could do back to the envelope math. Each customer's $37,000 average contract value with high, and they most likely have high gross margin because they're taking public information and just regurgitating it in a friendly way. So think
I'm
about
sure they'd love to hear that as their strategy. It's a regurgitation strategy.
No, but it's actually what they're doing is something very valuable. Like if any government collected data is kind of crummy to look at. And so you've got an industry that has very high capital costs in employees. I don't know what an average person makes like a hedge fund. I'm sure it's more than 50 grand a year. You also have something where timing is important, because if you can do analysis quicker, you can maybe do a trade faster. And, so what you've got here is something which is, you're probably making really high margins. You don't need many customers because they're going to pay you. Like if you're paying $37,000 and they're hiring one less employee, or they're making one good trade, there's an ROI. So to my takeaways here, again, SaaS, high margin business can get a higher multiple. But more importantly, it doesn't have to be the new product-led growth software. There is, understanding who your customers are and what the ROI you can provide for them can allow you to create large businesses with large value in places that don't look, that exciting or sexy. If you told me, hey, I'm going to look at SEC publications and find ways to make it easier to access, most 99% of your friends will say that,
Yeah, you're the 1% though, Alex. You would love that. That sounds like a social app for you. You want to add your friends. You want to share SEC filings. You want to
come on. I'm in Fin Twitter all the time.
All right, let's do one last headline today. Shopify enters China. How did they enter China?
Well, they teamed up with JD.com in a strategic partnership to bring American Shopify merchants to the Chinese consumers. And so for people that don't know JD.com, it has 550 million active customers in China. I don't think it's the biggest site, but it's big enough. I found this the most interesting news I saw all week, to be honest.
Okay, so what's your take here? What's your read?
Well, first of all, everyone in North America just assumes that it's Chinese manufacturers and retailers trying to reach North America. You think about Amazon, you always read articles about all these knockoffs. Wish.com basically exists to do this. So here you're having, American merchants going to the Chinese market. And it's interesting because when with the few American brands we think that have done well, or European brands are super high end, like Louis Vuitton, Tesla, Apple. So there's an interesting opportunity here that may not be public or may not be top of mind. So it'll be interesting to see how this does. I think this has a basically binary outcome, and either it's a huge success or we don't hear about it ever again. Right. And then a couple other takeaways. Look, I think Shopify can pull it. Like Canada doesn't have the best relationship with China right now. But if this was an American company trying to do this, it would be blocked right away. I think.
Right.
Like there's no way it would be done.
Yeah.
And
what do you think? Huawei 5G in Canada confirmed. Shopify starts new partnership with JD.com.
Yeah, there you go. And the final thing is the search for additional growth never stops, no matter how big you are.
And that partnerships team is busy. The things that they are doing is pretty impressive.
550 million more consumers for your, that's a pretty good email to get. Hey, we just doubled your potential customer.
And they're not even the biggest in the market, so there's still more opportunity for them. Holy cow! What a week in Canadian tech. If you haven't already, like and subscribe to TechTO wherever you're watching or listening, and we'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.